Good morning, ladies and gentlemen. I am Lizanne, the moderator for this conference. Welcome to the Q3 FY21 earnings conference call for Motilal Oswal Financial Services Limited. We have with us today Mr. Ramdev Agrawal, Chairman, Mr. Motilal Oswal, Managing Director and CEO, Mr. Naveen Agrawal, Director, Mr. Ajay Menon, CEO, Retail Broking, Mr. Arvind Hali, CEO, Home Finance, Mr. Shalibhadra Shah, Chief Financial Officer, and Mr. Rakesh Shinde, Investor Relations. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I would now like to invite Mr. Naveen Agrawal to make his opening remarks. Thank you, and over to you, sir.
Yeah, thank you, moderator. Good morning, everybody. It is my pleasure to welcome all of you once again to the Motilal Oswal Financial Services earnings call for the third quarter and the 9-month ending 31st of December. We hope that each one of you and your families are safe and in good health. We are happy to report our highest ever quarterly and 9-month profits. Our reported profits for the third quarter grew by 102% year on year at 3.3 billion, and for 9 months grew by 82% at 7.9 billion. Adjusted for gains on investments that account for nearly two-thirds of our net worth, our operating profit grew by 11% in the third quarter and by 16% for the 9-month period to 3.5 billion rupees. Our consolidated net worth touched all-time high and stood at 39.3 billion. Net debt is 37 billion. Excluding home finance debt, the net debt is 11.3 billion. The total debt equity is extra home finance debt has declined to 0.5, and we are net cash company net of the substantial equity investments that we hold on our book. Return on equity for the 9-month period stood at 34%. During this 9-month period, we've completed the buyback of equity shares amounting to 1.5 billion rupees including taxes, resulting in a small increase in promoter holding to 70.67%, still well below the permissible limit of 75%. The board has also declared the highest ever interim dividend of 5 rupees per share on a face value of 1 rupee per share. Turning to some of the business specific highlights in the broking business, despite constant chatter of the rise of discount brokerages, our broking business reported highest ever revenues, continued to gain market share by another 20 basis points to 2.8%. We witnessed strong traction in our chosen and more profitable area of cash markets, so highest ever quarterly client addition. We continue to make significant investments in expanding talent pool and distribution network, and also continue to benefit from the rapid consolidation of the broking business. On the asset management business side, lifetime high markets have lifted the AUM of the AMC business to its highest ever. Our mutual fund gross sales and SIPs gained traction. We introduced digital platform for onboarding PMS clients. And on the private equity and real estate side of the business, we've launched IREF4, which is our real estate fifth series, launched with a target size of 8 billion rupees. Turning to the home finance business, the highlights of the quarter were a sharp reduction, continued reduction in the cost of funds, and a tight leash on OPEX, which drove our pre-provisioning operating profit to a record high of 440 million in the third quarter. Collection efficiency improved to 94%, and we're expanding the sales force meaningfully in the fourth quarter and in FY22 to ramp up disbursements in the coming quarter. I'll now deep dive into individual businesses, starting with the capital markets business. This business comprises of retail, broking, institutional equities, and investment banking business. Revenues were at 4.3 billion for the quarter, up by 39%, and grew by 33% for the 9-month period to 12 billion rupees. This business contributed to 44% of consolidated revenues and 18% of consolidated PAT during the 9-month period. In the retail broking and distribution side of the business, our market share improved 20 basis points. We witnessed strong traction in new client addition driven by franchisee and retail channels, totaling to 190,000 clients acquired in 3Q itself. That's up nearly 3.5 times compared to the same time last year. Our active clients registered a 46% year-on-year growth to nearly 500,000 as of December 20. Distribution AUM was 120 billion, up by 15% quarter-on-quarter, with 13% of our 1.8 million broking clients tapped for a cross-sell. We expect continued increase in AUM and fee income as number of clients to whom we've cross-sold and number of products per client cross-sold increases. In the institutional broking business, the team had a really big win in Asia Money Polls 2020, where this business was ranked the number 1 best local brokerage house, the best research team, the best sales team, best sales trading team, and the best corporate access team. Strong improvement in domestic client rankings during the 9-month period, with top 3 rank retained in most clients is the highlight of this business. This has resulted in strong traction in revenues and profits for the business. The investment banking business continued to engage on a wide cross-section of mandated transactions across capital markets and advisory business. During the third quarter, we participated in one large OFS in the BFSI space, although revenues for this business remains muted and reported a net loss for the quarter. Turning to the asset and wealth management businesses, the asset management business AUM touched a lifetime high of 439 billion by 14% quarter-on-quarter. Profits for the quarter stood at 382 million, up by 32% quarter-on-quarter. The 9-month performance of the business is impacted by the lower average AUM, post unprecedented market correction in March, and also the cut in TRs in the mutual fund business. Mutual fund yields, however, have improved on a quarter-on-quarter basis. Our equity mutual fund AUM stood at 262 billion and is just 1.8% of the industry mutual fund equity AUM of 14 trillion. Our share of alternate assets comprising of PMS and AIF is the highest among AMCs at about 40%. We have witnessed strong traction in SIP additions and realizations. Our private equity business has a committed investment AUM of 65 billion across 3 growth PE funds and 4 real estate funds. Our first IBEF1 growth fund delivered an ex-IRR of 26%. The average IRR on exited investments in our real estate fund stands at 21+%. And we've now launched the 5th series of our real estate fund with a target size of 8 billion. Our wealth management business AUM stood at 227 billion, up by 13% quarter-on-quarter. Wealth business revenues grew by 31% in the third quarter and 20% for the 9-month period, led by strong net sales, which are up nearly 7 times year-on-year at 18 billion rupees. Gross and net sales were at a multi-quarter high. Our relationship manager count of this business stood at 124, and our trailed revenues predominantly cover our fixed costs. Turning to the home finance business, this business reported a profit after tax of 47 million. Our reported profit looks suppressed due to a high tax rate of 61%. We've explained this on the previous call. This is on account of reinstatement of tax asset post-migration to new regime. Cash tax for the quarter and the year end will be nil. NII grew by 20% year-on-year. NIM expanded 120 basis points to 6.4% in the third quarter. Yield on advances remained flat at 4.2%. Cost of funds fell 163 basis points year-on-year to 8.95%. And importantly, the marginal cost of raising the 11 billion for the 9-month period is at just 7.4%. And we expect the average cost of funds to trend lower in the coming quarters. Our loan book stood at 35.4 billion as of December. Disbursements were muted at 1.3 billion for the 9-month period. With new leadership in place for the business, this business, in our view, is geared for strong growth in disbursements as we substantially expand our sales force in the coming quarters. The gross NPA for the business was at 2.9%, net NPA at 2.3%. In 9 months, the total credit cost was at 606 million due to accelerated COVID-related provisioning. Operating expenditure was down to 215 million for the third quarter, down by 25% from highs. Cost to income ratio now stands at 33% compared to 44% in the same quarter last year. Strong support from parent continues, with capital infusion of 8.5 billion rupees till date. Net gearing for the business stands at a modest 2.9 times, and the Tier 1 capital adequacy is robust at 48%. We have limited borrowing repayments for the next 1 year. Strong undrawn borrowing lines, cash and balance sheet stand at 2.1 billion. All of this places us in a very comfortable liquidity position. Turning to our fund-based activities, this includes commitment to our asset management and other products. Total quoted equity investments, including unrealized gains, stood at 18.9 billion as of December, and including alternate assets stood at 26 billion. To sum up, capital market business, which is our oldest and cash cow business, has achieved new highs on all parameters and continues to benefit immensely from industry consolidation and our knowledge-driven digital offerings. Institutional broking business ranks number 1 local brokerage house in the Asia Money poll. Our strategy to invest business profits in our own equity investment products has registered highest ever profit, and as a result, our net worth has touched a new high as well. Our asset management business is likely to gain from improving product performance and its niche offerings. Home finance business turned very strong pre-provisioning profit under the new leadership. We expect sales to ramp up in the coming quarters. We remain excited about the headroom to grow and the ability to generate free cash by each of our businesses. We are now open for Q&A. Thank you.
Thank you. Ladies and gentlemen, we will now begin with the question and answer session. Anyone wishing to ask a question may please press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is on the line of Kashal Shah from CapGrow Capital Advisors. Please go ahead.
Hi, this is Prasheel here. Thank you for taking my question. So my question was on the broking side. So with the new margin norms being introduced by SERV, and by September we'll be seeing 100% margin requirement. So just wanted to get a sense of how that will be impacting your revenues, your volumes going forward. Any commentary on that would be helpful. Thank you.
Good morning. This is Ajay Menon here. As far as the implementation which has gone by, I've seen the first implementation which has come up of 25%. That has actually on the ground has not impacted much because overall the cash market share has gone up. But going forward, if you look at the implementation in March and then June, and finally in September it goes to 100%. I think the methodology which SEBI has followed, that we will implement in phases. The clients are getting into the groove of how to manage the whole situation. So we see that there can be some impact, but it should not be much because of the delayed implementation in 4 quarters, and people are very clearly getting aligned to the new margin mechanism, and the comfort of having the shares being pledge marked. People are much more comfortable doing the pledge mark now to get the margin exemptions. So we see that there will not be much impact in the overall pie of the revenues. Surely on the F&O side there can be some impact, but we see that that can be compensated on the cash market share of the business.
Yeah. So is it possible for you to share your revenue split between the cash market and the derivative side? On the revenues. So maybe some color on yields or something like that.
So we can share the mix separately,
But overall, if you see, we have a increase in the cash market share, whereas the F&O marginally on a sequential basis, there is a bit of lower market share. So, however, overall market share on a year-on-year basis has gone up. And in terms of the mix is broadly in terms of the volume, we are 95% F&O, 5% cash. Market is at about.
In terms of revenue, we are 50-50. In terms of cash, 50% is there in terms of revenue.
You said 50-50, right?
On the revenue side.
Okay. Okay, yeah, that's it from my side. I'll join back the queue if there are any further questions. Thank you.
Thank you.
Thank you. The next question is from the line of Nishit Shah from Equitas Investment. Please go ahead.
Good morning, sir, and congratulations on great numbers. Sir, I wanted to understand on broking side, why are the margins low?
Yeah. So on the broking side, actually, the margins, if you see, are marginally up year-on-year by about 100 basis. However, this is also after factoring the additional cost that we have taken on account of investing in the manpower. So over the last 9 months, actually, we added about 1,100 people in the business, and we have added further 60 branches in the course of this financial year. So if you see, we have actually there is an extra 5% overall cost because of this expansion that we are doing, and where the opportunity is clearly visible in terms of extra market share and the consolidation opportunity available in the market. So that is the reason where you see operating leverage, despite this cost addition, is also still up by 100 basis points.
And sir, this employee and branch addition exercise is done for the broking divisions, or going forward we'll see more of additions?
So largely additions are done. However, on the digital side, we'll be adding more people.
Okay. And sir, I wanted to understand, for the new client acquisitions, do we have significant upfront costs?
No upfront cost. No, so we don't have, because when the clients are added digitally, there is no significant upfront cost. In fact, the ARPU is very high for us. There is the cost.
There is surely some amount of lead generation cost, but that is we are managing that in a much more consolidated way. So we see that we can build up this acquisition digitally because our ARPU is much better. So we see that there can be a huge expansion on the digital side going forward.
Okay. And sir, has there been any pressure in cash yields for us because the market has been competitive of late?
There is no pressure on the cash yields. In fact, cash yields have marginally gone up year-on-year.
Okay. Sir, now coming to this Aspire, so we have added 50% sales force in Q3, right?
Yeah.
Yeah. So can you share the absolute number of employees we have in Aspire, and what is our target employees, addition do we target in next 1-2 years?
So absolute count of employees stands at 1,200 people in the housing finance business. And what we are targeting over next 6 to 8 months is further increase in the headcount on the sales side of the manforce, which is field on street people. So what we are targeting is could be increase of about 400 people on this. So it could be about 1,600 people over next 2 to 3 quarters.
Okay. And sir, any targets on disbursement side for Aspire? Long term, not short term.
So yeah. So hi, good morning. This is Arvind Hali from Housing Finance team. So basically, in the last couple of months, we have increased our field staff predominantly on the feet on street side by about 50%. And as Shally has just mentioned, it will go up to about 1,600-1,700 people in the housing finance team. The idea is that, the next financial year, we should look at a target of about 100 crores of disbursal in the last quarter of the financial year on a monthly basis.
Okay.
So the traction is there. We have been logging in around 800 odd files now in the last couple of months, which is a good sign. Sanction, is also improving, and so we feel that as the FOS keeps increasing, because ultimately it's a game of width of distribution and the depth of distribution. So
distribution did get impacted during the COVID period, but now it is coming back, and we believe that in the next financial year, we should be able to reach the 100 crores of disbursal on a monthly basis in the last quarter.
Okay. And sir, in Aspire, so is the provisioning major part of the provisioning done, or do we still expect provisioning in next 1-2 quarters? Sorry.
In terms of the provisioning, yes. So, if you see, we have been increasing the provision cover continuously in the course of this financial year due to the COVID impacts. Over the last 3 quarters also, we have increased the provision. Our closing provision stands about 50 basis higher than last financial year. So, that cover is already going up. And what we see in the course of next 2 quarters also, we will see the provisioning increasing further on account of the impact of the COVID on the book. So we have been continuously increasing this number.
Okay. Sir, now coming to this AMC side, can you give us figure of gross inflows and outflow for both mutual fund and PMS?
Yeah.
Yeah, sure. So the numbers are for the mutual funds for the quarter. The gross sales is 18.7 billion, and the net sales is minus 3.9 billion. Right. For PMS, the gross sales is 1 billion, and the net sales is minus 11 billion. For alternate assets, the net sales is a positive 1.2 billion, gross sales and net sales both. And if you add all of these up for the AMC as a whole, the gross sales is 20.9 billion for the quarter, and the net sales is a negative 13.9 billion. Okay. Thank you, sir. That's all from my side. Thank you.
Thank you. We'll take the next question from the line of Shubhranshu Mishra from Systematix. Please go ahead.
Hi, sir. Thank you for the opportunity. A couple of questions. The first is around the leadership team. So the past couple of years, in the last 2 odd years, we've seen a lot of churn in the leadership team. One at the home finance, we've seen roughly around 2 or 3 CEOs. In AMC, we've had a churn. In the wealth management, we again had a churn. So how do we read into this, sir? That's the first order question. Second order question, sir, we've always prided ourselves as active fund managers. So why are we entering passive funds? What is the thought process behind that? And yeah, those would be my 2 questions.
Yeah. So, hi, this is MOTILAL OSWAL. See, coming back to the leadership, we are a large organization with about now 6,000 people. 7 or 8 verticals if you look at investment management plus 5 support functions. So I think out of 12, 13 people, I think there is a kind of, I think always some kind of, I think changes which will happen. But let me tell you, there is no serious regrettable kind of, I think, attrition what we have seen at senior management level. The new leaders are far better than what we have seen the outgoing people. That's what the effort is at our side to make sure that leadership team becomes very, very strong, vibrant, and most importantly, the performing one. So we are not concerned with those kind of, I think, changes which some are deliberate and some kind of, I think, people have kind of seen exist because of their own aspirations or cultural issues. Coming back to the passive fund, Naveen will explain.
Yeah. So if you go back in time, the passive funds are not launched recently. It's more than a decade-old initiative. And the NASDAQ fund is the flagship fund in India on the passive side. We're aware, our active management is mostly India equities, or entirely India equities. And bulk of our passive business is international equities, so they do not compete with each other. The domestic funds that we have launched mostly form a part of a financial planning suite that you will see us eventually launching, and so in the coming quarters you will hear us on that front as well. So we feel that we are basically catering to all the needs. Our active management focus remains domestic equities. Our passive business is being driven by more and more international offerings, and the domestic passive funds that we've launched really are components of more holistic financial planning suite that you will see us follow through with.
Naveen, my question was not more about the tenor of the passive funds, but more about how we communicate with investors and all the stakeholders. We always put across that we are active fund managers. So in that, how does passive fund management fit in? And even if I look at the passive fund management, the TERs of those schemes are close to 40 bits. If we look at any of the competition, they would be 1/4 of that. So how do we look at it? So that is my question, not the tenor of such.
Yeah. So as far as the distribution locally is concerned, the discussion or the entire discourse surrounds active funds. Passive funds really have a strong pull just because of the kind of niche that they cater to. So really, the engagement, with our counterparts, whether it is investors, whether it is distribution, is largely around our active funds. The passive marketing is substantially, digitally led, and also, led by wealth platforms, because Indian savings are, barely, diversified across global equities, and so our products have been kind of the torch bearer for that. So I don't see any confusion in the minds of, if your question is that, is there any confusion in the minds of our investors or our distributors in terms of what Motilal Oswal Asset Management stands for? I don't think there is any confusion. We're basically active managers. These passive products, as I mentioned to you, as far as the domestic funds are concerned, are not marketed to the same channel and will eventually feed into, I repeat, the financial planning suite, which is more relevant for our retail, clients, mass retail clients, right? And the international funds have a strong pull because that's a niche that we really, chose a long time ago. I think Ramji would like to add a
little. Good morning, this is Ramdev Agrawal. This active versus passive discussion has just about started in India, and world over there is a massive transformation of allocation. Though in aggregate, the size of the funds managed has almost become almost equal to GDP. So the total market cap of the world is about 100 trillion, and 100 trillion is the GDP. Now, in the next 15 years, the global GDP will go to 200 trillion, and all the funds under management will also go to maybe more than 200 trillion. So the opportunity size on both ends are humongously large, and both stand on their own merits. Like here, we are saying that India is still a relatively inefficient market, so we have a active strategy which is right at the forefront. And on the passive side, we are trying to push more and more global equity allocations. Like today, maybe US is very popular. Tomorrow it could be China. Day after it could be Taiwan. So how do we access this market? Because we cannot produce active management from here. So our job is to give, our motto at Motilal Oswal is to help you make money worldwide in equity markets. And the way we can do worldwide is basically give active managers, best of the equity managers in India, and best of the ETF allocation worldwide. That's the thought process. Let's see how it pans out.
Sure. Thank you, sir. Best of luck.
Thank you. The next question is from the line of Madhukar Lada from HDFC Securities. Please go ahead.
Hi, morning everyone. So on the asset management side, the net outflow number for the PMS business is a little disconcerting. Can you explain what investor behavior is over there? Second, given that the upfront commissions are now not allowed for PMS, how do we see distribution changing for the asset management company and also wealth management? Because in wealth management we were distributing other asset management products as well. So how does business change, or how does strategy change there?
Yeah, hi Madhukar. So basically the alternate asset business is led by big ticket investors. The ticket size of PMS investors is 50 lakhs, of AIF is 1 crore rupees. And those investors follow asset allocation maybe more religiously than mass retail investors, and have been booking profits over the course of the last 6 months time, as 3 to 6 months time, as markets continue to rise. You've seen trend in redemption pick up. So the PMS outflows should be seen in the context that really there are two types of providers: the legacy providers and the relatively newer providers. The legacy providers have had their exit load period get over, very strong absolute returns, so substantial gains, and asset allocation suggesting booking of profits. So no exit load, significant absolute returns following asset allocation led to redemption, but they are also equally quick to come back to market. So you'll see them being earlier than mutual fund or mass retail investors to come back to equity. So that's point number one. Secondly, PMS as a product has established its relevance among the high net worth individual community. The portfolios are less diversified, more concentrated, and have delivered strong performances over long periods of time. Right, they are differentiated, and so the relevance of those products remain. However, there are other forms of alternate assets, including AIFs, that the distribution may resort to, and there's a strong traction in that already visible. In our own case, while the reported numbers of cross sales in AIF is 1.2 billion rupees, the commitment would be in excess of 5 billion rupees for the quarter, and you will see the drawdowns coming through in the coming quarters. So that's the second part. Sorry, what was your next part of the question, Madhukar?
So I wanted to understand how is distribution changing for the PMS and similarly for wealth management. So because we were also distributing other third-party products under wealth management, and now there is no upfront commission. So does that change our strategy? How does it change our strategy?
If you've been following our conference, Madhukar, closely, the focus has always been trail, and progressive distribution has always aligned their sales teams to trail form of incentives. A large part of the AUM resides in mutual funds, which had already moved to trail long ago. A far smaller part resides in alternate assets, where now PMS is also trail based. So really, building an upfronting model will have a cliff impact on the business eventually, and is not sustainable. So I think the only sustainable way to run the distribution business or the wealth business or running asset management sales is really the trail bearing model in our view. And we are progressively moving towards that.
But how does it impact our AMC? Because earlier we would have a lot of external partners who were distributing our PMS. Do you think there's any reluctance on their part? How do you see that industry evolving? Because in the last few years, last 5-6 years, a lot of assets were gathered because of the high, upfronting, of commission, right? So with this big shift, are we seeing any changes in the industry?
So let me just clarify. Some of the largest distributors of our PMS products distributed them because of the performance of the products or the differentiation of the products and not upfronting. In fact, even when there was an upfronting regime, the credits to the sales team was driven by trail, income. I mean, the firm may have earned upfront, but the RMs were not incentivized upfront, so that behavior does not alter, right? So that is one thing
that is for us internally, but for the other organizations who are selling.
I'm not talking about internally. I'm talking about third-party partners, non-Motilal Oswal distribution. I'm talking about multinational banks. I'm not specifically naming them, but they've already moved to trail-bearing credit even well before the regulatory changes. So that's the first point. Second is that there are also other alternate assets like AIFs where upfronting is permitted. And so, as I mentioned to you, there's increasing reliance on those products. So that will to some extent make up for, those distributors who are, focused on upfronting.
So one last question on the broking business. What percentage of the cash volumes is intraday volumes in our case?
It is 70%.
70%. Yeah. That's it from my side. Thank you, sir.
Thank you. A reminder to the participants, anyone wishing to ask a question, may please press star and 1. The next question is on the line of Raja Kumar, an individual investor. Please go ahead.
Yeah, good morning. Thanks for the opportunity.
Sorry, Mr. Kumar. Sir, we are not able to hear you clearly. Can you use the handset mode while speaking?
Yeah.
Hello, can you hear me?
Much better. Thank you.
Yeah. So I have a few questions. So the first one is on the home finance business. I just want to know what is the strategic reason for getting into this business, because it doesn't fit into your, even if you see your logo, you call yourself as the equity expert. So just want to know why we have moved to a fund-based activity when our forte is more, on the knowledge side of the business. And just to labor on the same point, I just want to know how do you think, you really think that you are late into this business, so just wonder what is the strategic, thinking, from the management side, you want to kind of scale it up and then hive it off, or how does it fit into the overall gamut of services?
So, Mr. Rajakumar, I think this question we answered over the last 6 years since we launched this business. But for your benefit, I'm going to repeat the answer.
I'm sorry for asking the same question.
Sorry to interrupt, Mr. Kumar. Sir, we are not able to hear you clearly.
Yeah, the reason why I'm asking this question is, you are written on network, written on equity on this side of business is very low, and that's kind of dragging your overall performance and, also on the performance of the stock. So, I would like to have, more color, and given the challenges that we currently have, what is the outlook the management has on this?
Good morning. This is again Ramdev here. See, building businesses, they take time. So one aspect is that it typically takes 5-6 years before the businesses can be said that they are already onto the successful track. Whether it is broking in 87 to 91, it took 4 years, even in simple broking. Then even asset management, we got the license in 2008, but we broke even in 2015. So it takes time. This is a lending business which is clearly new to us, and any businessman starts the business thinking that he can do a cakewalk. But of course, the first 2-3 years were cakewalk, and later we realized that we have to pay our own tuition fee. So most likely in last 3 years we have learned our lesson, and slowly we are kind of stabilizing, and it will see light of the day. We have enough determination, we have clear focus, we have good team. Our segments are decided, the economics are very clear. You can see the economics, pre-provision profit of this quarter, you see. The only issue is the credit cost. In lending, credit cost has to be seen very carefully. So it will take some time. It was hugely headwinded in the last 3 years. I hope, at least it is not, if there is no tailwind, it should not be headwinded. I think that is what exactly our expectation is. And so we will make a success of this. How big a success, how fast, that only time will tell. Now, relevance to this in the overall pie of Motilal Oswal is that we have huge free cash flow. Now, the way you are saying that we should not build business in lending, we should also, there could be objection that why we are building just the portfolio of the company, portfolio of mutual funds. So the issue is that we can deploy a lot of capital. That was the thought process, that the free cash flow can be deployed meaningfully at 15 to 20% return on equity in housing finance. That was the whole thought process. Of course, man proposes, God disposes. We are here witnessing almost 1,000 crores invested in this business, and now we are hopefully emerging out of this. And only time will tell, how we synergize all these businesses, and how do we make success of this particular line of business, and the stocks are already there in the market through ESOP. It will be offloaded as a separate company. You have to offload this company. So I think the current feeling that this company, line of business is in a contravention with the core of the company. That will, over the next 3-4 years, it will look very clear that housing finance company stands on its own, and other capital market businesses, they also stand on their own. Only thing is, in the short term, as a minority shareholder, I appreciate your concern about the stock price and a lot of concerns around that. But we as a business managers, we cannot be taking short-term view on the stock prices, but we have to build the businesses and the company. That has been the thought process. Okay?
Yeah. Thank you, sir. I think this is a wonderful explanation, sir. Sir, my next question is, I understand the company is generating a lot of free cash flows. So why? I mean, just two questions and comments. So I think we should be kind of focusing more on the AMC business, and particularly from the retail side, because that's kind of a sticky business, because the PMS will have given the ticket price will be higher, so but there will be a lot of volatility. And given the lower penetration of mutual fund products in India, I think we will have 2 decades of growth when it comes to the mutual fund industry, and also better valuation from a longer term perspective. So I would request the management to look at investing more funds, dedicating more funds into that kind of an activity, and given if there are any AMC comes up for sale or something, we should probably look at deploying our funds into those activities. I just wanted to get your comment.
Yeah, clearly we'll keep your suggestions in mind, but I can still tell you there is no conflict in pursuing growth potential in a free cash flow business. It doesn't require balance sheet. It requires only P&L, which we are pursuing. You might have seen in broking. Same way in asset management. We are moving very methodically and aggressively in the passive side. So there is a huge aggression in every business, and this is just a reinvestment into a new business. I mean, if you make a success, it becomes a billion-dollar business overnight. If you are failure, in that case, it is not worth the money you put. So that's how the reinvestment cycle works, and it's a growing company. Growth mindset is there. So we have our task cut out, and we are aware of this thing. But thanks for the suggestion. We'll keep in mind. Thank you. Yeah.
Thank you, sir. All the very best.
Thank you. We'll move on to the next question. That is on the line of Prashant Sridhar from SBI Mutual Fund. Please go ahead. Mr. Prashant Sridhar, your line is in the mode. Please go ahead.
Yeah, am I audible?
Yes, sir. Please go ahead.
Sir, sorry if I've missed it before. Have you covered what kind of restructuring has taken place in the housing finance and expectations?
Yeah, in terms of the restructuring that has taken place is about 75 basis points on the book is restructured till the end of Q3. And still we have time to 31st March, and we are in the process of looking at the overall collections and rollbacks. And this is that in Q4 we would be implementing the restructuring.
The restructuring is in line with the policy as approved by the regulator.
Sure. Just a few, data set questions. The GNPA, NNPA reported, does that include or exclude the Supreme Court judgment?
Yeah, in fact, we have not taken cognizance of the Supreme Court judgment at all in this, because when you calculate your stage 3 assets while reporting under Ind AS, you can't take that cognizance. So we have not taken any benefit of the Supreme Court judgment in the reported numbers. Had we taken the benefit, the GNP would have been 1%.
Sure. That's helpful. And lastly, would you have the split among 0+ and 30+ for the HFC portfolio?
Yeah, so 0+ stands at 17%. And 30 plus is 11%.
Sure. Thank you so much, sir. This has been helpful.
Thank you.
Thank you. The next question is from the line of Manish Poddar from Nippon India AIF. Please go ahead.
Yeah. Hi, thanks for taking the question. So just had one question. If you could probably, across the business verticals, what sort of investments do you require, let's say, for the next leg of growth? If you could highlight that, that would be helpful.
So, bulk of the only place where we can actually use the balance sheet is the mortgage company, where again, because of the current, stagnancy or actually declining, last 1 year has been a net decline. We are not able to deploy any more capital. But other places like broking, asset management, wealth management, they're all businesses where we have to use the current year's P&L to expand. And that's what is really happening, and it is not visible to the people how much we are reinvesting in our own business. So I don't think we have any huge capital, unless we acquire something. I don't think the free cash flow will be used anywhere else.
And would it be a fair understanding that, let's say, in terms of network and largely people investments, we are there across the business segments? Or do you think that you need, let's say, certain capabilities to be built in the next 2 or 3 years?
I think this is, if you look at the market shares in all our businesses, the scope to expand the network and people could be manifold, right? And while the broking business was seeming large and sizable and all that, if you look at the manpower addition in this business over the last 5-6 quarters, it has been massive, right? And so I think to really put a tap to, or let's say the asset management business had 25 branches 5 quarters ago. They are at 36 right now. Can they be 250 over a period of time? Easily. So I think the magnitude is in multiples rather than percentages. So, and that will unfold over a period of time. But and as RA alluded, all of these investments will be made through the income statement, and we will not shy away from any of these investments, notwithstanding what part of the cycle we are in. So you'd see us continuing to do that.
In fact, one of the ways we are growing is that by investing and bringing client commitments along with our own commitments. So when we invest, say, 10% of our fund in private equity, say we put up, say, 500 crores, we expect 5,000 crores to come from the client side. So though it looks like an investment of 500 crores, but it is a commitment to that particular product. And that becomes a kind of reinvestment for the firm and expand the total kitty of what money you are managing in private equity. So there is because the nature of equity business is such that the reinvestments happen either through P&L or through commitment as an investor. And that's what we are doing if you see across the board.
Got it. Thank you.
Thank you. The next question is from the line of Saurabh Dhole from Trivantage Capital. Please go ahead.
Sir, good morning. I have a couple of questions.
Sorry to interrupt, Mr. Dhole. So can you speak a bit louder? We're not able to hear you.
Hello. Is that clearer now?
Much better. Thank you.
Yeah. So I have a couple of questions. Firstly, on RM productivity, like if I look at the charts that you've shown on the presentation, about per RM basis, it's at about 40 families, and on an AUM basis, it's improved over the last couple of quarters. But if you were to look at RM productivity, what metrics do you generally track, and at what level would you think of adding RMs?
For the wealth business, I understand, right?
Yeah, wealth business, correct.
So, the business is very, very tiny. As you're aware, our AUM is 230 billion rupees. 2/3 of our RMs are yet to turn, profitable. So our viewpoint is that we will reinvest bulk of the cash flows in this business back into team expansion. We were predominantly a West India wealth management firm. We've strengthened the North Indian franchise meaningfully over the last few years. This year, FY21, the focus has been on strengthening South India. You will see us further strengthening, both all of these regions in the next 2 years' time. While we don't have a guidance number to give you in terms of how this will expand, really the business has turned, much more profitable this year despite predominant part of the revenues coming in from trail. We continue to make sizable investments. You will see the numbers go up quite sizably over the course of the next 12 months further. And that may have some adverse impact on the short-term profitability, but from a longer-term perspective, we believe that this is something that makes immense sense to us.
Okay. And sir, on the margin funding in the last book, could you just help me with what interest rates you're offering and what are the tenors here?
Yes, margin funding is the yield is about 13% on the book.
This is margin funding plus LAS, right?
Yeah, that's right. Margin funding or LAS.
And as in separately, they would also be very similar, or there's a distinct difference between margin funding and LAS?
So actually, typically for us, it is more of margin funding only that we do. We don't do any sort of promoter funding, which is in the nature of LAS. What is there is for the broking customers that we do margin funding, which I said is the average yield is about 13% on the book.
And the tenor would be?
So there's no specified tenure, but generally what we have seen the pattern is that the HNI clients typically take this funding for at least a year, where the funding remains outstanding. So it is a 1 year churning kind of a funding that we do.
Okay, and we don't have any ESOP funding, right?
No, not much.
Okay. And so lastly, on the home finance business, I know you, as in all lenders are under the Supreme Court judgment, but is there any sense that you can give us as to how the property prices in the geographies that you operate in are shaping up? As in, have you seen some sharp erosion from this?
So, in the last couple of years, we have seen some correction in the property prices to the extent of 10 to 20%, depending on the location. Surat, we have seen some correction in prices. Otherwise, it's not really been a very sharp correction beyond that. So about 10 to 20% is what we see.
Okay, and so connected to that, now all lenders today cannot take any action against the delinquent borrowers. But, hypothetically, once the forbearance or the dispensation that the Supreme Court has given, if that goes away, and all lenders go into the market selling the property, don't you think there will be a very sharp supply surge and consequent price correction?
Yeah, so I mean, we already have been using legal tools since the last couple of years, and we already have properties under possession. And definitely in certain pockets, as I mentioned, let's say, for example, Surat, or maybe one or two other locations, there may be excess supply in the market. But I guess, that's the part of the business cycle. So one will have to bear that loss and move on.
Okay. And sir, under the judgment, are you not allowed to even repossess, or the restrictions are limited only to...
No. So there are certain pockets, like for example in Maharashtra, there was some challenge, but otherwise, other than a few months during the COVID period, there were certain restrictions, but otherwise we are quite able to repossess properties and enforce SERV. As and when we get the DM orders, we are very much able to, take possession of the properties. Things have moved back into normalcy now since last couple of months.
No. What I meant was that under the, the GNP which is enjoying the dispensation, so today, are you restricted from repossessing, or are you restricted only from selling? As in, you can repossess, but you can't sell.
We can sell also. We have been selling properties also.
Okay, so this is also for the GNPA which is under the dispensation.
We have nothing under that.
Okay. Thank you so much.
Thank you. Ladies and gentlemen, we'll be taking the last question. That is on the line of Dikshit Joshi from Whitestone Financial Advisories. Please go ahead.
Yeah, thanks for the opportunity. Couple of questions. Firstly, in terms of housing finance business, do we give loan to borrowers who do not have an income tax return filed?
Yeah, I mean, we are basically, our target market customer is low income borrowers, LIG segment as we call it. People with income levels of about 3 to 6 lakhs is where we are largely concentrated. And 60% of our portfolio is salaried and about 40% is self-employed. So salaried portfolio is largely the ones where there is some or the other form of income documents, and some of them also cash salaried customers, where we take certain other surrogate means of assessing the salary credits which they receive in cash. On the self-employed side, which is about 40% of our portfolio, half of that is documented income customer, where they provide us with the income statements, bank statements, and ITR. But there are half of that is also assessment based, where we have our credit teams who go and meet the customer at their place of employment and place of business, and they basically assess the business in terms of the financial strength and in terms of the repayment capabilities, and accordingly we assess the amount of loan that the customer is eligible. We also do bureau checks, and we also have certain other checks in terms of the assessing the technical value of the property and the legal ownership of the property in terms of legal documents and encumbrance and other things. So a comprehensive check is done even for the cases where the income documents are not available.
So, looking at the current scenario, where there is a huge competition from public sector banks in terms of housing loans, our rates are almost upwards of 14%. So, how do you see next couple of years in terms of loan book growth? Because the prepayment would be much larger. Because even if somebody is not having, let's say, income tax return filed, and you are giving them loan after, let's say, couple of years history, they can switch to the banks. So how do you see in this scenario the loan book growth in housing finance?
So we see there is a huge market available there, where the regular banking does not reach, and we have customers who are into self-construction, even the salaried customer in semi-urban and rural areas, where you need to give quick turnaround time. Turnaround time is one of the key drivers here. And over a period of time, as the credit rating of the organization improves and the cost of funds which we have seen has also improved, so some part of that is also going to be passed on to the customer. But eventually, the main delta comes from the fact that we are able to quickly assess the customer's requirement, and we are able to turn around the applications fast and are able to provide them with the desirable loan within a desirable time period. So obviously, when you provide that kind of a service, so there is certain amount of premium that you can charge, and we are also fairly focused on self-employed customers. And when you look at the banking and public sector banks, and you look at the housing finance companies who are more focused on the salaried customers. So to that extent, there is also a fair degree of potential available on that side.
Okay. And one last question in terms of broking business. So obviously there is huge competition from discounted loan rates, and on the other end we are expanding the branches and also people. So how do you see this?
So as far as the strategy is concerned, so if you see, we have been also acquiring huge number of clients in the overall market space, and we have added about close to 4 lakh customers over last 9 months, and close to 2 lakh customers in Q3 of this financial year. So overall, we have been able to acquire clients and take the opportunity of consolidation available in the market for us. And what we are targeting versus discount brokers is definitely an advice-based brokerage, and a profitable market share. So that is the segment which we are operating into. So that is how we are yielding results out of that market consolidation opportunity available.
Just one last point. So maybe not in next couple of years or something, but let's say over 5-6 years horizon, do you feel that that there is a value migration kind of thing from normal broking to a discounted brokerage?
So we see that this discount brokerage is helping in increasing the industry size, and surely it's new customers, new millennials which are coming into the market. So the overall pie is becoming bigger, which is good for the industry on a whole. And we see that the value which we provide from the advice-based broking will continue to grow in this bigger scheme of things. So surely there will be more number of customers with discount brokers, but when we look at our pie of the whole value chain, I think we'll be able to get our quality of customers and advise them through our differentiated model. Plus, we have a big distribution network along with our broking, so that alignment will be well aligned to take it forward.
Okay. Thank you. That's it from my side.
Thank you. Ladies and gentlemen, that was the last question. I now hand the conference over to Mr. Shalibhadra Shah for his closing comments.
Yeah. On behalf of Motilal Oswal Financial Services, I would like to thank every participant for attending the Q3 FY21 con call. In case of any further queries, please do get in touch with me or our investor relations desk. Thank you and have a good day.
Thank you. Ladies and gentlemen, on behalf of Motilal Oswal Financial Services, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.